The Federal Reserve and the mainstream media are lying to you again. I'm going to explain what they're lying about. I'm going to give you the reasons why I think they're lying. And then I'm going to tell you what I think motivates them to continually lie. And I'm going to do that for you in 3 simple, fast steps. Step number 1, let's go over the soft landing. Everyone has been watching the news lately and realizes that the probability is very high that we go into a recession in the near future. But is it going to be a soft landing or a hard landing? Let's explore that first. I've got a chart going all the way back to 2000 to today's date. This is the 3-month Treasury yield versus the 10-year Treasury yield. So on the left, we go from -1% all the way up to 5% because we're looking for inversions, of course. And we start in, let's call it 98, about 1%. Then we see an inversion. We get the dot-com recession. And then the yield curve steepens significantly, but then it starts to go right back down. It gives us a warning for the GFC. Now, I want you to pay very close attention to how inverted this curve was just prior to the GFC. In fact, right around February of 2007. More on that in just a moment. That's a very important date, and you'll see why throughout the rest of this video. But during that time, the inversion was about 0.6% or 60 basis points. Of course, it steepens again. It inverts just prior to the cerveza sickness. So the next question becomes, where are we now, and should we be concerned about it? So we look at today's date, and the inversion is not 0.6, but actually double that, -1.2%. So I know a lot of you right about now are watching this and saying, okay, George, I get what you're saying, but I'm not an economic expert. If the yield curve is twice as inverted, does that mean the recession is going to be twice as bad? Well, not exactly, but you're getting close. Editor, let's go ahead and cut right to a clip from a recent discussion I had with my good buddy and PhD economist, Bob Murphy. Have you given any thought to the magnitude of the inversion? Because, we are talking about how 60 basis points, now it's 1.2%. And you had a listener say, hey, Bob, what does this mean that it's so inverted?
Right.
Have you given that any thought? And do you think that implies that there's a hard landing compared to maybe a soft landing?
I mean, that's my intuition. And so I guess, so this isn't mere, I'm coming from the Austrian School of Economics. And so we don't like to just look at data and, you want to have solid theory. And so what I did is reconcile this pattern with standard Misesian business cycle theory. And it does make sense, correct? Because in the boom, the central banks flood money into commercial banks are following suit and they're expanding credit, artificial interest rates get pushed down. But if you be more specific, that's kind of how the standard Austrian story goes. But then to be more specific and say, well, which interest rates? Well, it's the shorter term ones that are more malleable and that, bank policy has more effect on. And so that's, a quote, normal upward sloping yield curve would be in the midst of a boom in the Austrian framework. And then the bust happens when they chicken out or whatever, and they slam on the brakes, short rates rise above long rates. So if that's generally correct, then yeah, my intuition would be the more the yield curve inversion there is, then that means the more like either the prior boom was really inflationary and or they're really slamming the brakes hard, which would lead you to think. So it's actually probably better from a long-term perspective if you're an Austrian sort of sound money person to think, no, they're just pulling the Band-Aid off fast as opposed to, trying to trickle it out. But in terms of like how bad will the recession be right in the beginning, it's probably going to be worse than your typical recession.
So based on the Austrian view of economics, which is what Bob specializes in, if the yield curve is significantly more inverted, that would lead us to believe that we will not have a soft landing, but we will have a hard landing. Now, of course, there are no certainties. There are only probabilities. But what this is telling us is that the Fed has raised way too much relative to the amount of outstanding debt. And when those debts are rolled over, the misallocation of resources has to be wiped out of the system, including the malinvestment, which would lead you to believe that this time around it could be worse than what we saw during the GFC. And at the very least, the probability is a lot higher that we have a hard landing as opposed to a soft landing. So I'm sure right about now, your friend and family member Fred is going to be watching this video and saying, George, you're just fear-mongering again. Man, you just hate authority. The Fed is awesome. The mainstream media rules, but you just have a big chip on your shoulder. How do you know that just because we have a hard landing or whatever your stupid chart says, that the mainstream media and the Fed is actually lying? You have no proof whatsoever. In fact, prior to the GFC, the mainstream media and the Fed was most likely predicting that we would have a hard landing because they are the experts. You are just some schmuck on YouTube. All right. Well, your friend and family member Fred has a fair point. So, editor, let's cut right to the internet and we'll push back a little on your friend and family member Fred. Okay, let's go straight to the New York Times. Title of this article: Fed Chairman projects soft landing for the U.S. economy. The chairman of the Federal Reserve Board has given Congress an upbeat view of the U.S. economy, predicting that unemployment was likely to remain low over the next 2 years, even as inflation declined slightly. Okay, great. We know that we have very low unemployment right now, and we know that inflation is coming down. So this is good stuff, what the Fed is saying right now. And I'm sure you've heard this many times before, but let's keep going on down through this article. The Fed says a waning of the temporary factors that boosted inflation in recent years will probably help foster a continued edging down of core inflation. Okay, makes sense. We've definitely seen some disinflation lately. In contrast to the changing moods on Wall Street, Fed Chair Powell expressed a broad satisfaction that the nation remains on track for a soft landing, a modest slowdown in growth that would reduce upward pressures on prices without aggravating unemployment. Quote, the U.S. economy appears to be making a transition from the rapid rate of expansion experienced over the preceding several years to a more sustainable average pace of growth. And we've heard the Biden administration use this exact same phrasing to describe the current state of the economy. So I'm sure you're probably watching this video and saying, okay, George, I get it. I hear this in the news all the time. Why are you reading this story? I get it, for heaven's sakes. Okay, but I must confess, I myself have been lying for the last 2 or 3 minutes. You see, this New York Times article isn't describing what the Fed has said recently, although it's identical. This New York Times article is actually describing what the Fed said in February of 2007, just before we went into a global financial crisis, a financial crisis so bad it was something the United States hadn't seen since the 1930s. I would call that a hard landing. How about you? Step number 2, is it deceit or are they just simply incompetent? Well, I think they are lying to you about a soft landing, and here's why. Because they're always lying to you. And if they've always lied to you in the past, why wouldn't they be lying to you right now? And I think the Fed is motivated to paint a rosy picture, More on that in step number 3. But let me give you some concrete examples of them blatantly being dishonest. I've got this chart that goes back to, well, it actually represents AUC values. Now, I'm by no means a scientist. In fact, I almost flunked out of high school. I got horrible grades. I've never taken an econ class or a financial class in my life. But from what I gather, what this AUC value chart represents is as you get closer to the top, that is better. Meaning we've got 50% right here, 0.5, and we've got 1.0 representing 100%. So the closer you are to this 100%, that would indicate a high predictive value. So we start here at 0 months. We go all the way out to 24 months. And what I did is I pulled up a paper from the Federal Reserve in 2019 that shows an analysis of a lot of the predictive tools they use to determine if we are in a recession, if we're going into a recession, and the severity of a recession if we get there. Now, some of these tools, we'll list 7 of them in this first chart. And editor, you can go ahead and throw up that chart at your discretion. But we've got some very esoteric measurements, some metrics that I, quite frankly, had never heard of. But now I'm glad I did the research because I'll pay more attention to them in the future. First, we have this Conference Board Leading Economic Index. And I included that in our AUC value chart that is represented by this blue line. Next, we have BBK index, the yield curve short-term spread. We have the yield curve long-term spread. And this is the 3-month 10-year that we used in step number 1. And I've got that on our chart as well, represented in green. Then they've got 3 others, NFCI, which is the National Financial Condition Index. And then they've got the NFCI using or determining how much leverage is in the system. And then an ROC threshold index. The reason I didn't put any of these others up there is because I didn't want the chart to be too messy, number 1. And if you look at the conclusion of this paper, you see that the Federal Reserve themselves determined that the best indicator they had was the yield curve long-term spread. In other words, the 3-month yield minus the 10-year yield. So why is that important? Because it brings us to an example of their first lie that they're telling you right now. So back in 2019, when we weren't worried about a recession, they were saying that this was the most powerful indicator, the yield curve inversion that we used in step number 1. But editor, go ahead and throw up a new blog post from 2022 now that the yield curve has actually inverted. And what are they saying? The exact opposite. In fact, the title is Don't Fear the Yield Curve. And I've read this article several times, and that's basically the premise, how you should completely ignore the yield curve that they're telling you in 2019 was their most predictive tool. But it doesn't end there. Let's go ahead and throw up a chart of this Conference Board Leading Economic Index. And you can see that right now, it shows that we are most likely in a recession. And if we go back to the AUC value chart, we see that it has an incredibly powerful predictive ability to tell you when you are in a recession. And again, on the bottom, we go from 0 to 24 months. So just explaining this a little more thoroughly, what this is showing us is that at 0 months, the yield curve inversion has a pretty low predictive value because when you get to 50%, it's basically a coin toss. But at 12 months, it gives you a very high predictive value. So if the yield curve inverts, then within 12 months, it's very high probability that you're going to have a recession. But what this is doing is it's giving us information more in real time. So if it's showing that we're in a recession, that's not predicting that we'll be in a recession in the future like the yield curve. What that's telling us is that we're in a recession right now, because its highest predictive ability, almost 100%, is at 0 months. In other words, right now. So this is the second example of them being blatantly dishonest. How many times have you heard a Fed official lately come right out and say that, yeah, based on our best models, we are in a recession right now? They haven't said that. And this is my point. Now let's move on to another example, the SCI. Editor, go ahead and throw up a chart. And this is from the Philadelphia Fed, and it represents State Coincidence Index. That's just a fancy way of saying GDP for each individual state. So we can see when the states have negative GDP, or the states themselves go into a recession. And based on their model, if you get over 26 states flashing the red recession sign, we'll say, or negative real GDP, this means that there's almost a 100% probability that you are currently in a recession nationwide. I've done a couple videos on this, and what they said in the latter parts of 2022 is that we were over the threshold. In fact, 27 states were flashing this warning sign. They came right out and said, oh, whoa, sorry, time out here. We actually have a revision. It wasn't 27 states, it was actually 22 states. And now, in fact, we've got new data that shows currently it's only 15 states. So nothing to see here. Go ahead and move right along. Just ignore what we said 2 weeks ago, that there was almost a 100% probability that we were in a recession. You guys aren't stupid. What do you think happened? They came out with that report, and they most likely got a call from the New York Fed or from Jerome Powell and said, what on earth are you doing? You can't be honest with the general public, and the mainstream media, or let's say the alternative media, has picked this up, such as George Gammon's YouTube channel. So you've got to come out next week and say that you were wrong and go ahead and revise it so you don't freak people out. We can't tell them the truth. Step number 3, we've shown how there's a significant probability of a hard landing compared to a soft landing. And we've also shown how the Federal Reserve is basically telling you the opposite of what their models are telling them. So why do it? Why not just be forthright with the general public? Now here is where I'm going to give the people that work at the Federal Reserve and the mainstream media just a little bit of slack. I don't think that as a group they are inherently evil. Now, the majority of the people that work at the Fed, I would argue, have an insatiable lust for power. I think in any government agency or quasi-government agency, when it has this much control over markets, the economy, etc., it's going to disproportionately attract people who have a strong desire for that power and control. But I think there's more to it than them just lying for the sake of lying. Like, that's my point. Let me show you what I'm referring to. The first reason why I think they are blatantly dishonest and purposely try to paint a rosy picture regardless of what their models are telling them is because at heart they're central planners. I mean, let's be honest here. They think they are smart and you are stupid. In fact, I think if you got them all in a room and gave them a couple shots of whiskey, this is exactly what they would admit. You, the average Joe and Jane watching this video, can't handle the truth.
You can't handle the truth!
So why is this so important? Why do they need to deceive you? Why do they think it's for your own good? Well, first and foremost, because they themselves have financialized the economy. I think they realize this. And I always illustrate this phenomenon with hot air balloons. You've all seen them on a Sunday morning. And if the economy was functioning properly, meaning the real economy, was driving the financial economy, you would imagine it as if the hot air balloon was the real economy and the basket was the financial economy. So wherever that hot air balloon goes, the financial economy is going to follow. This is the way it should be. Makes sense. But now what we have is a financialized economy, so it's the inverse, the opposite. The balloon is actually the financial economy, and the basket is the real economy. So wherever asset prices go, so goes the real economy. And I think the people that work at the Federal Reserve realize that psychologically they have a huge impact on asset prices. So basically what it boils down to in their mind is a self-fulfilling prophecy. Kind of works like this. So let's say this is a Fed chart and it's showing that right now the economy is bad. We're heading into a recession or maybe even a recession with a hard landing. Well, if the government came out, and right here I'm using your drunk insolvent Uncle Sam as a proxy for the government or the Federal Reserve or any of those quasi-government agencies, and they came out and said, okay, we've got to admit, based on our data, it's really bad. Well, they think that the average Joe and Jane, or the average Joe here, and we've got Moody, the millennial, everyone's favorite millennial with their blue hair. You see, I don't know their proper pronouns, so we always want to be safe and go with their. And then we've got your friend and family member, Fred. And you all know one of those. So this represents the general public. So they hear the agencies, the Fed, let's say, come out and say, okay, based on our data, it's pretty bad. So they freak out and say, oh, shoot, well, we better start saving money. We better not spend as much. So that means fewer dollars going to business XYZ. The revenues go down. Business XYZ sees hard times in the future, so they tighten their belt. They fire employees. They stop investing in inventory and research and development. So this makes a bad situation even worse. It's a feedback loop that just takes us into this downward spiral into an economic collapse. This is why I think they believe it's actually their duty to lie to you. And when you aggregate a bunch of people that have an insatiable lust for power, most likely if you tell them that, hey, you're going to get more and more power, the more you lie, they're not going to have a moral issue with doing what they need to do. But it's not just me saying this. It's the Federal Reserve themselves. Editor, let's cut right to the internet. And this, by the way, is from the same paper where the Federal Reserve currently said that we should ignore the yield curve, the most powerful predictor, according to them, back in 2019. So I'm going to read a direct quote that I think summarizes their entire worldview. Nevertheless, as FDR, the president, might have pointed out, it can only make things worse if investors not only fear the prospect of a recession, but at the same time are spooked by that fear itself. In other words, let's deceive the public, because the only thing we have to fear is fear itself.
The only thing we have to fear is fear itself.
For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.